In a world where commodity prices seem to just keep climbing and inflation feels, well, constant, how has one company managed to grab all the upside of the gold boom while basically sidestepping nearly all the operational headaches that plague traditional miners? We're diving into a really unique business model today, one that reaps incredible rewards, often described as, perfection by the market. But the big question for you, our listener, is this. Is this company's valuation truly justified? Or is it, like the market hinted recently, already priced for perfection? Get ready as we unpack the ins and outs of Franco-Nevada Corporation, ticker FNV. This deep dive is based on a stack of comprehensive research, including a detailed report titled Deep Research, Franco-Nevada Corporation. We'll explore its business, the management team, financials, what the market thinks, who owns it, key risks, the whole picture. And we'll wrap up with a clear evaluation of this summary. Before we jump in, just a quick note. Please remember to like and subscribe to the Victoria Ounce YouTube channel. We cover all sorts of mining companies, and we definitely take requests for stocks in the precious metal space.
Okay, let's get into it. We're kicking off with Chapter 1, Business Analysis. So we're focusing on Franco-Nevada Corporation, Canadian-based, gold-focused royalty and streaming company, trades as FNV on both the TSX and NYSE. Our analysis is anchored to August 12, 2025, and we're looking at a closing share price of $175.64 from August 11th. What's fundamentally different about Franco-Nevada compared to, say, a traditional mining giant?
Well, what's fascinating here is that Franco-Nevada isn't really a miner in the traditional sense at all. It doesn't own or operate mines. Think of it instead as a specialized financing partner. It provides upfront capital to mining and energy companies, and in return, it secures a long-term interest in their future production or revenue.
Okay, so unpack this for us. What does this unique model mean for the miners themselves, and, what are the direct benefits for Franco-Nevada?
Right. So for the miners, it's a really flexible alternative. They don't have to take on debt or dilute their shareholders by issuing more stock. They get the capital they need without adding liabilities or giving up equity. And for Franco-Nevada, well, this model gives them direct, leveraged exposure to rising commodity prices and, crucially, new discoveries. And they get this without the headaches of operating costs, things like fuel, labor, equipment maintenance, all that stuff. They are essentially insulated from those inflationary pressures that can really hit traditional miners hard.
That insulation, yeah, that sounds like a key differentiator. And this approach leads to a highly diversified set of revenue streams, right?
Absolutely. As of Q2 2025, precious metals make up 82% of their revenue. That breaks down to 70% gold, 10% silver, and 2% PGMs, platinum group metals like palladium and platinum. Energy assets contribute 14%, and other assets make up the remaining 4%. Geographically, the vast majority, 86% of the revenue, comes from the Americas. That's quite notable.
Okay, let's talk about their core products, so to speak. They have two primary forms of agreements. How do those actually work?
They do. So first, you have royalties. Typically, this is a net smelter return, or NSR, royalty. Here, FNV receives a percentage of a mine's revenue from production, after some deductions, of course. And crucially, this is for the life of the mine, regardless of the operating costs involved for the miner.
Okay, life of mine, no matter the costs.
Yeah.
Got it. And the second type?
The second type are streams. Now, these are metal purchase agreements. FNV makes a large upfront cash payment, and in return, they get the right to buy a fixed percentage of future metal production at a deeply discounted, predetermined price. Imagine securing the right to buy gold at, say, $400 an ounce for the entire life of the mine, no matter if the market price goes to $2,000 or $3,000.
Oh. It sounds almost too good to be true, doesn't it? Like striking gold without having to dig the hole yourself. And this model has clearly positioned them as a leader in this space. Just how big are we talking here?
They truly are leaders. Franco-Nevada describes itself as the leading gold-focused royalty and streaming company with the largest and most diversified portfolio. Their market cap is around $33.8 billion. They boast over 400 assets worldwide, and 118 of those are currently producing cash flow for them. Their main competitors. You're looking at companies like Wheaton Precious Metals and Royal Gold.
So the value proposition seems pretty clear. For you, the investor, it looks like a lower risk way to get exposure to precious metals. And for the mining companies themselves, it's a vital source of flexible, non-dilutive long-term capital. Makes sense.
And if we connect this to the bigger picture, the precious metals market itself is projected to grow. We're talking about a 7% RAGR, that's compound annual growth rate between 2025 and 2032. Things like persistent inflation, global economic uncertainty, geopolitical risk, they're all driving factors. Plus, you have central banks increasing their gold reserves. So this whole macroeconomic backdrop is actually very favorable for a company like Franco-Nevada.
But how competitive is this niche space they operate in?
It's basically an oligopoly, dominated by just a few large, well-capitalized firms. Franco-Nevada really pioneered this model. They were the trailblazers. Competition here isn't about who can mine gold the cheapest. It's about who can structure and execute the best financing deals. You need sharp technical teams, strong balance sheets, and critically, a solid reputation. Now, Wheaton Precious Metals actually has a slightly larger market cap, but Franco-Nevada's portfolio is arguably more diversified, especially with those energy assets included.
And regulation, even though they don't operate the mines, it's still crucial for them, isn't it?
Absolutely. If one of their operating partners gets shut down due to non-compliance, environmental issues, permits, whatever, that directly impacts FNV's revenue stream from that asset. So this means their due diligence on partners' ESG principles, their environmental, social governance track records, it's absolutely a cornerstone of their risk management strategy.
That makes perfect sense. Okay, what about barriers to entry? If someone wanted to start a new company doing this, how hard would it be?
Oh, they are formidable. Really high barriers. First, capital. Just one single major deal can easily require over $600 million up front. That's a huge check to write.
100 million. Wow.
Yeah. Second, technical expertise. You need a deep bench of experienced geologists and mining engineers to properly assess these complex long-term projects. You can't fake that. And third, reputation. Mining companies are committing to these deals for decades, sometimes the entire life of a mine, so they only partner with firms they know are proven, reliable, and financially sound. Franco-Nevada has built that reputation since its inception.
So beyond just pioneering the model, what truly gives them their enduring edge today?
Well, their brand name is almost synonymous with the royalty and streaming model itself. That carries weight. And it's constantly reinforced by a long history of successful partnerships and, increasingly important, strong ESG ratings.
Okay, here's where it gets really interesting for the investor, I think, the cost side.
Yes, their cost structure is a profound advantage. It's a core reason for that priced for perfection view sometimes. Consider this. They generated over $1.1 billion in revenue in 2024 with only about 45 employees. 45.
That's incredible efficiency.
It leads to extraordinary profitability, like the 99.0% adjusted EBITDA margin they reported in Q2 2025. A 99% adjusted EBITDA margin. I mean, that's almost unheard of for a company of this scale. It just shows how structurally protected they are from operational cost inflation.
And their agreements, as you said, are basically forever, right? For the life of the mine. That must lock in cash flows for decades.
Precisely. Switching costs for their mining partners are, well, effectively infinite. Once that deal is done, it's done. These royalty and stream agreements are registered interests in the property. They last for the entire life of the mine. This creates incredibly durable, predictable, and locked-in cash flows for Franco-Nevada, often spanning decades.
And finally, their portfolio itself. Over 400 interests. That's a unique asset, and they benefit from something called exploration optionality. What's that about?
Right. So exploration optionality means they benefit at no additional cost to them from any new discoveries made by the operators on the lands where FNV holds an interest. If the mining company finds more gold or extends the mine life on that property, FNV's royalty or stream automatically applies to that new production too. It's like free upside. And their core capability here is that expert in-house technical team, which is absolutely key to identifying these promising long-term investments with that kind of potential.
All right, that's a fantastic breakdown of the business model. Let's now turn our attention to the people steering the ship in Chapter 2, management evaluation. What's the leadership like at Franco-Nevada?
The senior leadership team at Franco-Nevada is really characterized by deep industry experience and exceptional tenure, very stable. The current chair, David Harquail, was actually the founding CEO back in the day. The current CEO, Paul Brink, has been with the company since the 2007 IPO, and the CFO, Sandeep Rana, joined back in 2010. This kind of continuity is often a hallmark of a stable, long-term oriented organization.
Okay, and their biggest test recently has definitely been the Cobre Panama mine shutdown. That was a huge revenue generator for them.
Yeah.
How did they handle that significant challenge?
Yeah, that was major. Their response, I think, was really a model of conservative financial management and, importantly, transparent communication. They took the full impairment charge right away. They removed Cobre Panama completely from their forward guidance, and they consistently framed any potential restart as purely a free option, basically, pure upside that wasn't factored into their current outlook at all. This approach manages investor expectations very prudently, I'd say.
And their communication with you, the investor, you felt it's been consistently clear and credible throughout this. Yes, consistently so. Even in their record-breaking Q2 2025 report, CEO Paul Brink celebrated the great results but also took care to manage expectations. He highlighted new assets coming online for future growth, but also acknowledged the negative impacts from lower prices on some of their diversified, non-gold assets. This level of transparency, along with their high ESG ratings from places like Sustainalytics and MSCI, really builds trust over time.
So with all that available capital they generate, how do they decide where to put their money? What's their allocation strategy?
Capital allocation is absolutely central to their business model. Their strategy is disciplined and very long-term focused. They concentrate on expanding their portfolio with high-quality, long-life assets, and they maintain that fortress-like balance sheet with zero debt. This gives them, as of the latest figures, about $1.1 billion in available capital to act opportunistically when good deals arise.
And the recent deals, they seem to tell us something important about maybe a subtle shift in strategy, don't they?
They do seem to. They've made some significant acquisitions in 2025, like the royalty on IM Goldie's Côté Gold Mine in Ontario and another on AngloGold's Arthur project in Nevada. What these deals highlight is a clear focus on long-life assets located in politically stable jurisdictions, Canada, the U.S.
Right.
Now, while they haven't officially announced a strategic shift, it strongly suggests a deliberate move to de-risk their geopolitical exposure. Probably a key lesson learned from the whole Panama situation.
Makes sense.
Yeah.
It also seems they really favored dividends over share buybacks, looking at their history.
Indeed. They have an absolutely exceptional track record here. They've increased their dividend for 18 consecutive years. That's every single year since their 2007 IPO.
18 years is impressive.
It is. The most recent increase was 5.6%, bringing the annual rate to $1.52 fast per share. And importantly, it's supported by a conservative payout ratio of just 36.31%. That means it's well covered by earnings with plenty of room to grow further. They even encourage long-term ownership through a dividend reinvestment plan, or DRIP, which offers a 1% discount on reinvested shares. Share buybacks, not really a significant part of their capital return strategy.
Okay, and for a company whose whole business is investing capital, return on invested capital, or ROIC, is a key metric. How effectively are they using shareholder capital?
That's a great point. How good are they at deploying that capital? Franco-Nevada's ROIC currently stands at a healthy 9.61%. This indicates the leadership team is quite proficient at identifying and executing deals that generate strong, profitable returns over the long haul.
Okay, from strategic decisions and management quality, let's shift focus now and dive into the numbers in Chapter 3, Financial Analysis. As of August 11, 2025, you mentioned Franco-Nevada's market cap on the NYSE was about $33.84 billion. How have the revenue growth trends looked over the past 5 years or so?
Yeah, their revenue trends are quite interesting to look at. There was strong growth initially, but then 2023 and 2024 saw temporary dips, the numbers were. 2020 saw plus 20.86% growth. 2021 was plus 27.43%. 2022 slowed to plus 1.21%. Then 2023 saw a dip of negative 7.35%, and 2024 was negative 8.65%.
Those declines in 23 and 24 aren't typical for them.
Yeah.
What was the story there?
Right. Those dips were almost entirely due to the production halt at the Cobre Panama mine. That was the main culprit. In fact, the company's own filings indicate that if you exclude the impact of Cobre Panama, their revenue in 2024 would actually have increased by a solid 15%.
Ah, okay, so context is key there.
Exactly. And their trailing 12 months, or TTM revenue, as of March 34, 2025, shows a clear return to growth. It reached $1.225 billion, which is up 2.14% year over year. So they're back on track.
That makes sense, linking the revenue dip directly to that specific event. Now let's talk about those profit margins. They seem pretty extraordinary, don't they?
They really are. Their business model is basically engineered for exceptionally high margins. It's fundamental to how they operate. With minimal operating costs of their own, rising commodity prices flow almost directly down to the profit line. For the trailing 12 months ending Q1 2025, look at these numbers. Gross margin was 69.84%, operating margin 66.53%, and net profit margin a very strong 50.41%.
Half the revenue is in net profit.
And remember that Q2 2025 number? Their adjusted EBITDA margin hit an incredible 99.0%, primarily due to the surge in the gold price during that quarter. These figures are remarkably strong and truly set them apart from almost any other sector, let alone mining.
Okay, free cash flow. Another important metric for investors. It looks like it dropped quite significantly from 2022 to 2024. Is that a warning sign? Should listeners be concerned?
That's a really important question. Does lower free cash flow, or FCF, always signal trouble? Not necessarily, and especially not for Franco-Nevada. For them, lower FCF often indicates periods of heavy investment in future growth. They're deploying capital. So while FCF did decline from about $0.86 billion in 2022 down to $0.43 billion in 2024, their cash flow from operations remained very strong. It was $829.5 million in 2024. The decline in FCF was actually driven by aggressive deployment of capital into acquiring new royalty and stream assets. They committed over $1.3 billion to acquisitions and commitments in 2024 alone.
So it wasn't that cash generation faltered, it was that they were spending more on investments.
Exactly. So in their case, it's arguably a bullish indicator. It shows significant reinvestment back into their portfolio to drive future growth.
That's a crucial distinction for our listeners to understand. And in terms of overall financial stability, their earnings consistency seems notable if you ignore that one big Cobre Panama write-down.
Precisely. With the exception of that large non-cash impairment charge they took in 2023 for Cobre Panama, their underlying earnings power has been consistently positive and strong. If you look at their adjusted net income, which strips out those kind of one-time items, it clearly shows durable profitability year after year.
And they have basically zero debt, you mentioned.
That's right, zero. Their debt-to-equity ratio is 0.00. They have a long-standing disciplined policy of operating completely without debt. They fund all their acquisitions through existing cash flow and cash on hand. This financial conservatism is a key pillar of their lower risk profile.
And their current ratio, which measures liquidity, is exceptionally high too, something like 22.92. That suggests immense liquidity.
Yes, extremely liquid. And again, reinforcing the financial stability is that dividend record we talked about, 18 consecutive years of increases, stable cash flows, and that conservative payout ratio of just 36.31%.
Okay, let's switch gears slightly to valuation. How does Franco-Nevada's price-to-earnings, or PE ratio, compare? We hear they often trade at a premium.
They absolutely do. Franco-Nevada consistently trades at a premium valuation compared to the broader market and even traditional miners. As of August 2025, its trailing 12-month PE is hovering in the range of, say, 48 to 55. Now, while that's high objectively, it's actually below their own 10-year historical average PE, which is up around 74.
Interesting. So high, but maybe not high for them historically.
Exactly. And compared to their direct royalty and streaming peers like Wheaton Precious Metals, its PE is around 68, or Sandstorm Gold, way up over 100. Franco-Nevada's PE is actually in line, or even a bit lower right now. But compared to a traditional miner like Barrick Gold, trading around a PE of 15, it's significantly higher. It clearly shows the market puts a real premium on the perceived safety and quality of their specific business model.
Right. Now, moving beyond market multiples, let's talk intrinsic value. You use a discounted cash flow, or DCF, model for this analysis. Can you briefly explain what that tells us?
Sure. We used an educational discounted cash flow model. The basic idea of a DCF is to estimate a company's intrinsic value, what it's fundamentally worth, by projecting all its expected future cash flows and then discounting those future cash flows back to their value in today's dollars. Essentially, the premise is that a business is worth the sum of all the cash it will generate over its entire lifetime, adjusted for the time value of money and risk.
Okay, and based on that educational DCF model you ran, what's the estimated intrinsic value range for FNV shares?
Based on our key assumptions, which we'll get into, the estimated intrinsic value for Franco-Nevada shares falls within a range of approximately $165 to $190 per share.
$165 to $190.
Yeah.
Okay, what were the critical assumptions that went into generating that DCF range?
Right, assumptions are key in any DCF. For the growth rate, in the short term, a relatively high rate seems justified. Analyst consensus, for example, forecasts earnings per share growth of about 15% from 2025 to 2026. For the long-term, or terminal value growth rate, we used a more conservative 2.5% to 3.0%. This reflects expectations for long-run inflation and general global economic growth.
And the discount rate, that reflects the riskiness, right?
Exactly. For the discount rate, given Franco-Nevada's exceptionally low risk profile, remember, zero debt, very stable cash flows, diversified portfolio, and a very low market beta of around 0.41.
Beta of 0.41 means it's much less volatile than the overall market.
Correct. Significantly less volatile. So given all that, a relatively low discount rate is warranted. We used a range of 7.5% to 8.5% in our model.
Okay, that provides good context for the valuation range. Let's shift gears now and look at how the market is generally feeling about Franco-Nevada in Chapter 4. Market sentiment. What's the buzz on Wall Street?
Well, the consensus rating among analysts covering the stock is currently a buy, so generally positive. However, there's a really wide dispersion in their price targets. This suggests quite different views among analysts, probably on where gold prices are headed, and importantly, the likelihood of that Cobre Panama mine eventually restarting. The median target is around $188, but individual targets range from a pretty modest $152 all the way up to an extremely bullish $315. That's a huge range.
Wow, $152 to $315. Yeah, that shows some disagreement. And what's the general media tone around the company lately?
It's largely positive, naturally focusing on the record financial results they reported recently, driven mainly by the strong gold rally. However, there's definitely a nuanced theme emerging, which connects back to that priced for perfection idea. For instance, despite beating earnings per share estimates by 13% in Q2 2025, a solid beat, the stock actually declined that day. Why? Because they had a very slight revenue miss, about 1.7% below expectations.
So even a big earnings beat wasn't enough if revenue wasn't absolutely perfect.
Exactly. Headlines captured this. Things like Franco-Nevada shares tumble nearly 5% as revenue miss overshadows record earnings. It really underscores the market sentiment that the stock might be priced so high that even minor disappointments can trigger a negative reaction. Priced for perfection.
That certainly highlights the scrutiny they're under. What about short interest? Are many institutional investors actively betting against the company?
No, short interest is exceptionally low. It's sitting at just 1.57% of the public float. This signifies a very strong bullish consensus among major investors. Very few institutions are willing to bet against Franco-Nevada's long-term stability and performance.
Okay. And technically speaking, how about the stock's momentum? Is it trending up or down?
Currently, it's exhibiting positive momentum. At that $175.64 price level, it's trading above its 50-day simple moving average, which is around $164.26. That typically indicates a bullish short to medium-term trend, and the long-term trend is also strongly bullish. It's trading well above its 200-day simple moving average, which sits lower at about $145.80.
All right, let's move on to Chapter 5. Ownership structure. Who actually owns Franco-Nevada stock?
Franco-Nevada is predominantly owned by large, sophisticated financial institutions. They collectively hold approximately 86% of the outstanding shares. This high institutional ownership generally shows strong confidence from professional investors, the folks who, do deep due diligence.
And we're talking about some pretty big, well-known names here, right? Major fund managers.
Oh, yes. The top institutional holders include names like FMR LLC, that's Fidelity Investments, and Massachusetts Financial Services Co., known as MFS. Both hold around 6.3% of the company. Other major holders include FAL Ltd, Capital World Investors, the Vanguard Group, and Van Eck Associates Corp. Many of these have very long-term investment horizons.
What about insider holdings? How much skin in the game do the executives and directors themselves have?
Insiders, the executives and directors own about 0.73% of the company. Now, while 0.73% sounds like a small percentage, the actual dollar value involved can be quite substantial. For example, CEO Paul Brink's holdings were valued at over $57 million as of June 2025.
Okay, $57 million is definitely significant. We have seen some insider selling reported recently. Should that be interpreted as a red flag for you, the potential investor?
That's always a fair question. While insider selling can sometimes be a bearish signal, in this context, I think it's important to look at the full picture. These executives have held stock for many years and seen significant appreciation. It's actually quite common and often prudent for them to periodically sell a relatively small portion of their holdings for personal financial planning, diversification, maybe buying a house, funding education, things like that. CEO Paul Brink, for instance, recently sold about 14,251 shares for around $3.3 million.
But relative to his total holdings, that's not a huge chunk.
Exactly. The key is that these recent sales appear relatively small compared to their total holdings. So it doesn't necessarily signal a negative outlook on the company's future. However, it is also worth noting the complete absence of any reported insider buying recently. This might suggest that management doesn't view the stock as significantly undervalued at its current price levels.
That's a balanced perspective. And finally, how concentrated is the ownership among these major institutions?
It's actually quite concentrated. The top 7 institutional investors alone control over 30% of the company's stock. This level of concentration means their buying or selling decisions can have a meaningful impact on the stock's price and liquidity. It also implies they likely have significant influence and access to management, which often helps ensure high standards of corporate governance.
Okay, that covers ownership. Let's now delve into Chapter 6, risk assessment. A good way to frame this is often a SWOT analysis: strengths, weaknesses, opportunities, threats. What are Franco-Nevada's core strengths that really set it apart?
Right. The SWOT framework is useful here. Their core strengths are clear. First, that superior business model we've discussed, capital light, high margin, offering leveraged commodity exposure while being insulated from operational risks and costs. Second, a highly diversified, high-quality portfolio with over 400 long-life assets, which reduces dependence on any single mine or jurisdiction. Third, that fortress balance sheet completely debt-free with over $1 billion in available capital, giving them immense flexibility and acquisition firepower. And fourth, an experienced management team with very long tenure, a proven track record of disciplined capital allocation, and shareholder-friendly policies like that consistent dividend growth.
Okay, solid strengths. What about their internal weaknesses? What are the key limitations inherent in their model?
Good question. Their main weaknesses really stem from the flip side of their strengths. First, they have no operational control. They are entirely dependent on their operating partners, the mining companies, for actual production levels, efficiency, and cost management at the mines. If a partner messes up, FNV feels it. Second, their growth is inherently M&A dependent. Organic growth is limited outside of exploration optionality, so future expansion relies almost entirely on their ability to continuously source and execute new royalty and stream deals. They have to keep finding good investments. And third, despite diversification efforts, there's still significant commodity concentration. Around 70% of their revenue still comes from gold, making them heavily reliant on the price of that one commodity.
Makes sense. Now, looking outside the company, what market opportunities could they potentially capitalize on right now?
There are several key opportunities. First, the favorable macroeconomic environment. Persistent inflation, ongoing geopolitical risk, general economic uncertainty. These all tend to create tailwinds for gold as a safe haven asset, potentially boosting the price, which directly benefits FNV. Second, their acquisition firepower. Having over $1.1 billion in available capital and zero debt means they're extremely well positioned to make more high-quality acquisitions, especially if market volatility creates opportunities. Third, that Cobra Panama free option we talked about. The potential restart of that mine, which is currently valued at zero in their guidance and market expectations, represents significant potential upside without any additional cost to them.
Right, pure bonus if it comes back online.
Exactly. And fourth, that embedded exploration optionality. They continuously benefit from any new discoveries made by their partners on the lands where they hold royalties or streams, providing a sort of free organic growth potential over time.
Okay, and finally in the SWOT, what are the external threats they face, the things outside their control that could hurt them?
The major threats are primarily external. First and foremost is commodity price risk. A sustained downturn or bear market in gold prices would directly and significantly impact their revenue and earnings. That's their biggest single exposure. Second is geopolitical and partner risk. As seen so dramatically with Cobra Panama, political instability, resource nationalism, or major operational failures at a partner's mine can halt revenue streams unexpectedly. Even with diversification, a major asset going offline hurts. And third, there's the risk of increased competition for deals. The success and high margins of the royalty and streaming model haven't gone unnoticed. More competition could potentially emerge, driving up the prices FNV has to pay for new acquisitions, which could erode future returns.
That gives a good overview. How do broader macroeconomic factors like inflation and interest rates specifically impact a company like Franco-Nevada, given its unique model?
Okay, let's break that down. Inflation. Generally, this is largely a net positive for Franco-Nevada. Why? Because inflation often drives investors towards gold as a store of value, potentially boosting gold prices, which helps FNV's top line. Crucially, as we discussed, FNV's business model is inherently shielded from the negative impact of rising operating costs, labor, fuel, etc., that directly hit traditional miners during inflationary periods. So they get the upside without the cost downside.
Right, that's a key point. What about interest rates?
Interest rates. Rising interest rates pose a more direct threat, generally speaking. Higher rates make competing safe haven assets like government bonds, which start paying higher yields, relatively more attractive compared to non-yielding gold. This can put downward pressure on the gold price. Also, from a deal-making perspective, significantly higher interest rates could make traditional debt financing seem relatively more appealing again for some mining companies compared to royalty streaming deals, potentially reducing FNV's pipeline of opportunities, although royalty streaming offers other non-price benefits.
Okay, let's talk about a specific geopolitical factor that's been in the news. The U.S. imposed tariffs of 2025 on certain imported metals. How does something like that affect Franco-Nevada even if they aren't directly targeted.
Yeah, that's a really relevant example of indirect risk. This is a material indirect threat. While the tariffs aren't levied on Franco-Nevada itself, tariffs of, say, 25% to 50% on imported metal like copper, for example, can severely damage the profitability of their operating partners who produce that metal and rely on exporting it to the U.S. market. If a partner's copper production suddenly becomes uncompetitive in the U.S. due to a new 50% tariff, it could lead them to reduce production or maybe accept lower prices. Either outcome would directly reduce the royalty or stream payments FNV receives from that operation.
So even if FNV isn't the target, trade disputes can ripple through their portfolio.
Absolutely. It highlights how global trade disputes, even ones that seem unrelated at first glance, can create significant risk across their diversified portfolio due to their reliance on the success of their partners.
Very clear.
Yeah.
Okay, finally, let's bring it all together as we arrive at Chapter 7, Conclusion. Can you summarize the core bullish case for Franco-Nevada, tying together everything we've discussed?
Sure. The bull case really rests fair and square on the fundamental superiority of its business model. It offers leveraged exposure to rising commodity prices, especially gold, while being uniquely insulated from those operational risks and inflationary cost pressures that plague miners. This structure leads directly to exceptionally high profit margins. This powerful model is backed by a pristine, completely debt-free balance sheet holding over $1 billion in cash ready for growth opportunities. Add to that a deeply experienced management team with that remarkable 18-year track record of disciplined capital allocation and consistently growing dividends. And finally, the current macroeconomic environment, with its persistent inflation and geopolitical uncertainty, provides a potentially powerful tailwind for gold, their primary commodity. That's the bull case in a nutshell.
Okay, a compelling bull case. Now, on the flip side, what's the core bear case? What are the key risks that could challenge this seemingly perfect picture?
The primary risks, or the bear case, center on factors that are largely external and beyond Franco-Nevada's direct control. First, as mentioned, a sustained bear market in the price of gold would directly hit their revenue and earnings. That's unavoidable given their business. Second, the stock's consistent premium valuation means it's often perceived as being priced for perfection. This implies that even relatively minor operational hiccups, slight misses on quarterly expectations, or negative macro news could trigger disproportionately sharp sell-offs. There's less room for error. And third, geopolitical risk is very real, as the Cobre-Panama situation demonstrated so vividly. Political instability, contract renegotiations, or unexpected shutdowns in less stable jurisdictions where they have assets could significantly disrupt revenue from key producing assets. Diversification helps, but a big hit still hurts.
So bringing it all together then, what does our estimated intrinsic value based on the DCF tell us when compared to the current share price?
Right. Based on our educational discounted cash flow analysis, we estimated the intrinsic value for Franco-Nevada Corporation to be in the range of roughly $165 to $190 per share.
And their current share price, as of August 11th, 2025, was $165 to 64 cents.
Exactly. So $175.64 falls squarely within our estimated intrinsic value range of $165 to $190. What this suggests is that the market, at least based on our model's assumptions, is currently assigning a fair value to the company. It seems to be accurately reflecting both its powerful strengths and unique business model, but also pricing in the inherent risks we've discussed. At its current level, the stock doesn't necessarily jump out as a deep value opportunity, but nor does it seem excessively overvalued compared to our estimate of its fundamental worth. It seems fairly priced.
So what does this all mean for you, our listener? Well, while Franco-Nevada undeniably offers a truly unique and arguably lower-risk way to gain exposure to the often volatile precious metals market, its current valuation suggests that many of its impressive advantages might already be baked into the share price. The real question for you then becomes, given its apparent priced for perfection status, what could truly move the needle for Franco-Nevada from here? Is it just continued flawless execution year after year, a major game-changing new acquisition, or perhaps a positive resolution in Panama that the market currently isn't expecting? Something to think about. That was our deep dive into Franco-Nevada Corporation. We certainly hope you gained some valuable insights and maybe even a few surprising facts today. Don't forget to like and subscribe to the 1 Trey Ounce YouTube channel for more deep dives into mining companies and precious metal stocks. And finally, just a quick but very important note. This analysis was generated by an AI system purely for educational and informational purposes. It should absolutely not be considered financial advice. Please, always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.